Building materials retailer Cashbuild's revenue for the half year to December was up 9% compared to the previous year. In its operational update, the company said that it opened 6 new stores, which contributed 1% of the increase, while existing stores contributed the other 8%. Ashraf, I actually want to start on that last point, which is the revenue contribution of the stores. 6 new stores increasing 1%, and of course the existing 185 stores making a contribution of 8% to that 9% revenue increase. Isn't there a natural limit to the number of stores that they can have? Because Cashbuild seems to be all about stores.
Well, Cashbuild is predominantly in the peri-urban areas. And yes, there is a limit to the number of stores. I think they are starting to reach that natural limit. But, you know, there are also certain urban areas or certain peri-urban areas which are developing into urban areas. And that's really where they're finding the opportunities. Also, you know, home building over the past 3 years has not actually slacked to the extent which home sales have, because people have done renovations and extensions to existing homes because they cannot afford to buy up. So that, to a large extent, has helped Cashbuild as well.
Let's come to Mark in Cape Town now. Mark, I just want to get a sense of how the company performed in terms of its geographic footprint. Obviously, Cashbuild has got operations in Lesotho, Namibia, Swaziland, Botswana and Malawi. Give us a sense of revenue per region and transactions per region, please, for Cashbuild.
Okay, unfortunately at this stage I haven't actually been able to drill into the details and be able to give you a geographic breakdown. The main bias I've had is looking at the figures in terms of domestic output.
Can you give us a sense of how they were compared to the likes of Massbuild, though, which is part of Massmart? Are there any overlaps in terms of the operations and the business models? And from a valuation point of view, would a shareholder be going for the likes of a Massbuild rather than Cashbuild? What advantages do they have over the likes of Massbuild?
Look, inevitably there are a number of overlaps in terms of geographical distribution and in terms of product range, so to speak. The key thing with Cashbuild is that it has a high degree of inelasticity in terms of passing on input costs directly through to client base. And I think that may be a key kind of discriminator in terms of its comparison with other kind of local competitors.
Well, another discriminator, Ashraf, is the fact that they have such a worker-friendly attitude, and in the recent recession they didn't retrench any workers. In fact, they increased workers' wages by up to 13%, management's wages by between 7 and 8%. They even bought 50 million of its own shares from a BEE trust. What do you make of this worker-friendly environment?
Well, it certainly helps with staff morale, and ultimately their view is that it will help to lift productivity. And I also share that view with them. You know, companies where you're investing in your staff, especially through the lean times, when times are good, then the profits certainly come through the doors. So yes, I like it as a business. It's a very well-run business. To me, the price always has to be right in terms of entry points. Right now, I think it is fairly valued. It's had a good run over the last 6 months relative to the rest of the market. So, you know, as I see it, a business that will continue to be profitable, and one I'd certainly like to take into a private equity fund because of its strong cash generation.
Well, we'll come back to you when we go to a vote for Cashbuild. Let's go over to Mark now and just get a sense of how viable a boom is in the construction and building industry, and getting heavy, low-value building projects into Africa certainly isn't as viable. So should shareholders be looking for that industry boom rather than a move into Africa for Cashbuild's next growth drivers?
Look, obviously that's a very, very difficult question to answer kind of accurately. In terms of the current share price and valuation, we are right at the top end of pricing for this particular share, a P of about 17.2, which is a little bit on the heavy side. In terms of where demand is going to come moving forward, yes, there is to a certain degree a secular shift into the central and sub-Saharan areas, so there is huge potential for addressing this particular niche. Whether Cashbuild is up to that at this stage, I think still has to be determined. And secondly, we have to really await the kind of broad-based economic throes we're experiencing at the moment to say whether the share is reasonably priced for attacking that niche at the moment.
And so how would you vote then, Mark, on Cashbuild? Hot or not for you?
I would say it was hot, and I'd say it's just about just going off the boil now. Still an attractive share, a good long-term prospect, but in line with a lot of the principal stocks at the moment, which obviously depending on niche are at the high end of the range. I would back off at the moment and wait for a bit of better value.
Sounding like not hot for Mark, wants to wait for a little bit of value. Now they closed at 117 Rand this year, just shy of their 12-month high of 118 Rand. What do you make of Cashbuild? Hot, not for you, Ashraf?
In short, not. But I do believe relative to, if you want to play the retail sector, this could be one of those to invest in, because it is a very solid business.
Now, gentlemen, you both pretty much voted not hot, but Mark, I just want to come back to you very quickly and get your sense on their strategy to be buying up properties. Obviously, the likes of City Lodge and ShopRite have done that quite successfully, buying properties that they own. What do you make of the strategy for the likes of Cashbuild?
Look, I think it's proven in almost any sector you can think of that companies that do acquire their operating premises and general property, etc., do tend to place themselves very strategically. In terms of current regional property valuations and rates, etc., it may well be a very, very perceptive strategy to be deploying at the moment.
Thanks, Mark.
I like it.
Now, Ashraf, is going to seem like a case of deja vu, because last week you were on the show, we were discussing a trading update by Ellies. Let's move on to the news flow that's out today by Ellies. Their first half headline earnings per share rose almost 40% to 218 cents, driven by increased orders from the group's African mining clients. Revenue increased 10% to 721 million rand. The electronics manufacturer and distributor did not declare dividend due to short-term funding requirements to support working capital needs. Mark, let's start with you in Cape Town. 38.8% increase in headline earnings per share to 20.98 cents for the 6 months ended October 2011, up from 15.12 cents. And they said that the results were driven by a recovery in Megatron, which is Ellie's infrastructural electronics segment, and that contributed 35% of total group revenue. Now, Megatron was a traditional business focusing on custom-built power generation plants within the housing and municipal environments. What has been behind Megatron's growth?
Well, look, it appears to be again another story of making further developments throughout Africa. They attribute a lot of their well, I've heard Wayne Sampson attributed quite a high degree of their success or their revenue through to developing of mining infrastructure. And as we know, there are a number of very substantial projects taking place, of which they've been involved to late. Looks fairly stable and fairly reliable, and maybe set to continue at this stage. You
mentioned that there are a number of substantial products, Mark, that they're engaged in. Could you just elaborate on those for us?
I'm not aware of specifically which projects Megatron has been supplying in terms of infrastructure.
But from the point of view of their geographic footprint, what are they going to be doing in the likes of Zambia, Zimbabwe, Swaziland, just Ellie's group as a whole?
Yeah, look, I know they've got quite a large presence in the DRC and more central Africa as such, rather than the kind of peripheral areas. As far as moving forward is concerned, I'm not too sure. I mean, the impression I got from announcements made by the company and by Wayne Sampson was that yes, Megatron is a key asset and a performing asset for the group at the moment. But Ellies should be viewed to a certain degree as a very diversified portfolio of potential high revenue generating projects.
Thanks.
And my perspective in looking at Ellies has rather been from that point of view than trying to assess the extent to which Megatron can roll out.
Thank you, Mark. And just on that note of diversification, Ashraf, let's come to the move now that they are going to be going into alternative energy solutions. They're improving their relationship with Eskom, obviously on the back of increased electricity costs, wanting to offer alternative energy. What's your take on that?
I think it's a very long road, and I don't think they'll extract any margin from their electricity generation business. Just to go back to Megatron, you know, Megatron is involved in providing parts for substations, providing inverters, etc. And as Eskom tries to stabilize the grid, they're certainly going to have to buy those products from the likes of Megatron. And as electricity expansion occurs in the rest of Africa, Megatron will certainly be well placed to take advantage of that, which explains its 115% profit before tax growth. And I think if we strip that out, then the rest of the businesses look rather bleak in terms of performance.
So it sounds, Ashraf, as if this is the sort of share that you would buy for management's ability to find winners rather than holding it for dividends, because they only declared a dividend of 5 pence per share last year. They didn't declare an interim dividend now. Why else would you hold the stock then if not for dividend and if not for management's ability to pick winners?
Well, it's on a PE of around, I think, 6.3 at the moment after these results. So it certainly looks cheap, but I think it deserves that cheap rating because of the working capital strain. Normally when companies are starting to struggle, working capital strain is the first sign.
Let's come to Mark in Cape Town now. This is a share that closed at R2.75 today. Lowest 12-month high of R3 and above its 12-month low of 166. What do you think is on the horizon for Ellies' share price?
Well, I think the downwards, the 7.4% move down today may have been due to two kind of factors. Probably the sell on fact story, number one, and then the second issue being the pushing out of the DTT contracts through till the third quarter of maybe even later this year. And maybe that's been perceived as putting a strain on, not a potential strain, but as being a delay in the process kind of warming up. I do think moving forward, it is difficult to assess a stock like this. You are, as you so rightly said a little while ago, taking a leap of faith in terms of the management's number one, their abilities, and number two, their portfolio of interesting potential projects. Working capital does seem to be a little bit of an issue, especially when you're involved in so many projects.
Let's come to another project that they're considering now, which is the migration to digital television. They're going to be installing set-top boxes with Altec. I saw you shaking your head as Mark was making his commentary. What do you make of the move to DTT by Ellies?
Well, Ellies is certainly well positioned, and that will help them in terms of revenue growth. But one must also accept that that's a once-off. Once people have done the conversion, we're seeing it with the multi-choice DSTV. They're giving the set-top boxes away and really trying to gain subscribers. Ellies won't get subscribers out of that. So they'll sell the set-top boxes at a margin, and it really, to me, is a once-off experience, and then they'll have to find other areas of growth. So, that is really the challenge that they face as a business. There's no constant revenue coming through.
No constant revenue coming through, says Ashraf. Mark, just give us your quick sense before we go to vote hot or not on Ellies. They said that Skyvine has been slow to achieve initial objective, and management is taking a conservative approach to its future developments. Now, this was a partnership that they did with Skyvine in the United Kingdom to provide high-speed internet. What exactly is happening with the Skyvine venture?
I'm not fully briefed on that, I'm sorry.
Oh, you're not? Okay, well then perhaps something you are fully briefed on is your vote. How do you feel about Ellies, hot or not for you, Mark?
Yeah, look, comments taken in terms of Megatron, as kind of mentioned by the other member of the panel. DTT is not a long-term revenue stream proposition. Renewable energy is a challenge and will remain a challenge, I think, for some time in this area. The high-def TV area is also interesting, but one's taking a stock which is has a track record of sometimes producing a little bit of magic out of situations, and one can't put any kind of take any kind of firm view or get a firm handle on where it is going to be moving forward. I feel that the stock is again probably not hot. The PE seems adequate given the lack of concrete kind of moving forward.
Not hot for Mark. Ashraf, we know what you voted last week when we covered the stock. Has anything happened in the previous week to change your mind?
No change from my view 2 weeks ago. I still would not be buying it.
You would not be buying it at all, but last time you mentioned that you would consider it as a private equity play.
I think it should have remained unlisted. Cash generation, when they get their working capital under control, is fairly strong, and that's really what they need is a better discipline when it comes to working capital.